103 ETFs. That's how many Vanguard offers right now. Most people pick VOO or VTI and call it a day. Nothing wrong with that. But it means they're ignoring 101 other options on the same platform. In this video, I'm testing all 103 Vanguard ETFs: large cap, mid cap, small cap, international, sector, dividend, and factor. I took $10,000 and ran it through every Vanguard ETF to see what would happen. I ranked them all, and some of these results genuinely caught me off guard. At the end, I'll show you a Vanguard ETF that turned $10,000 into over $28,000, plus a second winner that outperformed VOO over 1 year and 5 years, and barely anyone knows about it. Here's what I'm doing. I'm taking every ETF Vanguard offers, all 103 of them, and putting $10,000 into each one. Then I'm measuring 2 time frames. First is the 1-year return, showing what happened over the last 12 months. Second, the 5-year average annual return, which shows the bigger picture. That is, what kind of results you get when you hold through rate hikes, market crashes, recovery rallies, and everything in between. 5 years covers a full cycle. The 5-year number is what crowns the winners in this video. 1 year can be a fluke. 5 years is a pattern. Now, 103 is the full list, but not all of them have been around long enough to matter. Some launched last year, a couple are only a few months old. So if a fund doesn't have at least 5 years of real performance data, it's not in the competition. That filter brings us from 103 down to 76. Before we get into the stock ETFs, let's talk about the other side of the Vanguard lineup. 15 of those 76 ETFs are bond funds: treasury bonds, corporate bonds, inflation-protected securities, international bonds, tax-exempt bonds. Vanguard covers the full fixed income spectrum. And look, I know nobody clicked on this video to hear about bonds, but they're part of the 76, so they're part of the test. The 5-year winner is VTIP, the short-term inflation-protected securities ETF at $11,923. The worst? BND, the most popular bond fund on the entire platform, at just $10,207, a 0.41% average annual return over 5 years. Inflation ran at 2 to 3 times that. You didn't just earn almost nothing, you actually lost purchasing power by holding it. And there's a reason. The last 5 years included one of the most aggressive rate hike cycles in decades. When the Fed raises rates, existing bond prices drop. Short-term bonds recovered faster because they mature quickly and roll into higher rates. Long-term bonds got locked into low rates for years. BND holds a mix of everything, and that mix got dragged down. The 1-year picture is a bit better. VWOB took the top spot at $11,159, an 11.59% return. Emerging market bonds caught a bid as global rates started coming down and investors went hunting for yield outside the U.S. At the bottom, BNDX, the total international bond ETF, at $10,392. International bonds in developed markets just didn't move much. The entire bond segment, all 15 funds, sits between $10,207 and $11,923 over 5 years, a spread of barely $1,700. Bonds did their job, they preserved capital, they just didn't grow it. This video is about finding the winner, and no bond fund is in that race. So now the real competition starts. 61 stock ETFs across 7 segments, and the first one up is the segment most people skip right past: mid-caps. These are the companies stuck in the middle, too big to be small caps, too small to be big names everyone talks about. Most people scroll right past them. Let's see if that's a mistake. There are 7 Vanguard ETFs in this segment. I ranked all 7 by their 5-year return, and yeah, the results caught me off guard. Top spot goes to VOE, the mid-cap value ETF. $10,000 in this fund 5 years ago? That's $17,003 today, an 11.2% average annual return. Second place, IVOV at $16,120. Third, IVOO at $15,386. Look at the 5-year column in the table. The top 3 are all value funds. Growth didn't win this race. And it makes sense when you think about what happened over the last 5 years. We went through one of the sharpest rate hike cycles in decades, and when rates go up, companies that are priced on future earnings, growth companies, get punished the hardest. Value companies? They already have the cash flows. They already have the profits. That's why they held up. Now, at the bottom, VXF, the extended market ETF, $10,000 became $12,915. The name makes it sound like you're getting more, and you are. You're getting more of everything, including the stuff that dragged the returns down. Now check the 1-year table. See how IVOG jumped from 5th to 1st? That's the same growth style that lost over 5 years. VOE came in right behind at $11,966. The gap between them over 1 year? Less than $100. Over 5 years? Over $2,400. That flip tells you something. As rate cuts started showing up on the horizon, growth found its legs again. The 5-year window caught the pain of rising rates. The 1-year window caught the start of the comeback. Same 7 funds, completely different story depending on when you zoom in. At the bottom of the 1-year ranking, VOT at just $10,798. A growth fund won the 1-year race, and a different growth fund lost it. Even within the same style, which index you're tracking makes a real difference. That rate hike pressure didn't just hit mid-caps, though. Small caps felt it even harder, and the spread between the best and worst in that group is the widest I've seen by far. So here we go with 9 Vanguard ETFs in the small cap segment. These are the smallest publicly traded companies, and if you think mid-caps had a big gap between the best and worst, wait till you see this. The 5-year winner is VBR, the small cap value ETF. $10,000 turned into $16,149. Second, VTWV at $14,437. Third, VB at $14,124. Value swept the top again. Why? Well, small companies carry more debt than large ones. A lot of that debt is floating rate. When the Fed raised rates, their borrowing costs went up immediately. Value companies had the earnings to absorb that. Growth companies did not. Look at the bottom of the 5-year table. VTWG at $11,215. Now look at VBR at $16,149. That's nearly $5,000 between them. Same size companies, same 5 years, the widest spread in any segment so far. Now flip over to the 1-year table. See VTWG? It jumped from dead last to 3rd place, a 21.95% return. The worst 5-year performer came back to life in 12 months. The Fed started signaling rate cuts, and small caps reacted fast. Small caps showed us 2 things. Over 5 years, value crushed growth. Over 1 year, growth staged one of the biggest comebacks. Does that same pattern hold in the large cap segment? 16 ETFs? We're about to find out. Next, I'll show you funds that beat VOO across both timeframes, 5 years and 1 year. And in the end, I'll show you a fund that turned $10,000 into over $28,000, and another that beat VOO and VTI, ranked in the top 5 over both timeframes, and the majority of investors have never even looked at it. But first, let's look into the large cap ETFs. This is the one everyone's likely been waiting for. Large cap is the biggest segment in this entire competition. 16 Vanguard ETFs, and this is where VOO and VTI live. Let's see where they actually rank. The 5-year winner? is MGC, the Mega Cap ETF. $10,000 turned into $19,706. Not VOO, not VTI, but MGC. In fact, VOO or VTI didn't even make the top three. The top three are all concentrated bets on the biggest companies: Apple, Microsoft, Nvidia, Amazon. They're sitting on mountains of cash. They don't need to borrow. MGC holds about 185 stocks. VOO holds over 500. That extra concentration pushed MGC to the top. If you look at the table, find VOO. It's fifth, $19,381. Good, but not first. VTI? Even further down, at $18,165. Now check the one-year table. VT, the Total World Stock ETF, sits at the top, $12,505, a 25.05% return. The same fund that came in last over 5 years just won the one-year race. Look at how the 5-year column next to it is deep red, $17,272, while the 1-year column is bright green with over 25% a year return. Our next segment is factor funds. All right, so this one's different. Most people watching this video have probably never heard of factor ETFs. Here's the short version. Instead of tracking an index like the S&P 500, factor ETFs pick stocks based on a specific trait: momentum, value, quality, or a mix of all three. Think of it like a filter on top of the entire U.S. stock market. Vanguard has 5 of them. The 5-year winner is VFMF, the U.S. multi-factor ETF. $10,000 turned into $19,466. Look at the 5-year column. See that green at the top? Now compare it to VOO's $19,381. VFMF beat VOO. A fund most people have never heard of outperformed the fund everyone owns. Now, at the bottom, VFQY at $15,706. Quality alone didn't keep up. As for the one-year return, VFMO jumped to the top at $12,747. But look at its 5-year column next to it. It's yellow, not green. $17,592. Momentum rides the highs, but catches the falls. VFMF stayed balanced and won the longer race. 5 ETFs most people would never look at, and the winner nearly matched the most popular fund on the platform. Returns? They don't care about attention. Okay, so now we go from the segment nobody talks about to the segment everybody loves. Dividend ETFs are next. There are only 4 of them in Vanguard's lineup: 2 domestic, 2 international. You'd think a small segment like this would be straightforward, but it's not. One of these 4 funds didn't just beat its own segment, it beat every large cap ETF in this entire competition. And the 1-year number? I had to double check it. Look at the table. See VYMI? It's green across both columns. 5-year column, green. 1-year column, green. That almost never happens in this video. Every other segment had one fund win the 5-year race and a different fund win the 1-year race. Not here. VYMI took both. $20,044 over 5 years, $14,559 over 1 year. That's a 14.92% average annual return over 5 years and a 45.59% return in the last 12 months alone. An international dividend fund, not a tech fund, not a growth fund, just beat VOO, VTI, and every single large cap ETF in this entire competition. It holds over 1,500 stocks across 40-plus countries, heavily weighted toward financials and energy. Now look at the bottom. VIGI at $13,778 over 5 years. Same international exposure as VYMI, but VIGI focuses on dividend growth. Companies that have been raising their dividends year after year. Sounds smart, But over the last 5 years, the companies paying the highest dividends right now outperformed the ones growing their dividends slowly over time. Immediate yield beats future yield. The gap between them is over $6,000 from the same international markets. So what drove VYMI's one-year explosion? Well, two things. International stocks were trading at a massive discount to U.S. stocks heading into last year. We're talking price-to-earnings ratios nearly half of what the S&P 500 was sitting at. When that kind of gap starts closing, the money moves fast. And on top of that, the U.S. dollar weakened. Every stock VYMI holds is priced in a foreign currency. When the dollar drops, those holdings become worth more in dollar terms. It's like getting a bonus return on top of the actual stock performance. And that international income story doesn't stop here. The next segment is all international. 9 ETFs, and one of them just had the single best year out of all 76 ETFs in this entire video. We're talking $10,000 turning into $15,559 in 12 months. Let's get into it. 9 Vanguard ETFs in this segment: Europe, Asia Pacific, emerging markets, global real estate. The full international lineup. If you've been watching the one-year numbers build throughout this video, this is where they peak. Let's start with the 5-year picture first. VGK, the FTSE Europe ETF, took the top spot at $17,358. VEA came in second at $17,203. Solid numbers, but look at the 5-year column. Nothing in this segment cracked $18,000. Compare that to large cap, where the top 5 all cleared $19,000. Over 5 years, international companies just couldn't keep up with the U.S. And at the very bottom of the table, VNQI, the global ex-US real estate ETF, at $11,342. International real estate got hit from every angle. Rising rates crushed property valuations globally, and this fund held some of the most rate-sensitive assets in the entire competition. Now, flip over to the one-year table. This is where the whole segment transforms. VPL, the FTSE Pacific ETF, returned 55.59% in 12 months. $10,000 became $15,559. That's the single highest one-year return across all 76 ETFs in this entire video. Nothing else is even close. Look at how green that one-year column is at the top, and then check the 5-year column right next to it. It's sitting in yellow. VPL is about 60% Japan, and Japan had one of its best years in decades. Japanese companies started aggressively buying back their own stock, returning cash to shareholders and restructuring their balance sheets in ways the market hadn't seen before. Corporate earnings surged, and on top of that, currency moves gave VPL an extra tailwind that amplified everything. But here's what makes VPL such an interesting case. Over 5 years, it finished at $15,966, a 9.81% average. That's middle of the pack in its own segment. All of that 55% gain was concentrated in the most recent 12 months. For 4 out of 5 years, VPL was just average. One explosive stretch rewrote the entire story. And that's the lesson. If you'd given up on this fund 2 years ago, you would have missed the biggest single-year return on the entire platform. All right, last segment, and I saved the best for last. And remember, in the end, I'll show you the most balanced fund across all the segments that beat almost everyone when both timelines are compared. But first, let's look at the sector funds segment. In this segment, Vanguard has 11 ETFs. Each one is a concentrated bet on a single slice of the U.S. economy, whether it's energy, tech, industrials, financials, you name it. And the overall 5-year champion of this entire competition has been sitting right here the whole time. Take a look at the 5-year table. We've got VDE at the top, $28,325. That number is so far ahead of everything else on this chart that the gap between first and second place is over $7,000 from the same $10,000 starting point. That is a massive difference. Here's the story behind it. When COVID hit, oil prices collapsed and energy stocks got completely wiped out. Nobody wanted anything to do with them. But then, demand came roaring back. Supply stayed tight, and oil pushed past $100 a barrel. ExxonMobil and Chevron started posting record profits and returned all of that cash to shareholders through buybacks and dividends. VDE rode that entire wave from the bottom all the way up. Now, if you switch over to the 1-year table, it's a completely different picture. VIS, the Industrials ETF, came out on top at $13,309, driven by all the infrastructure spending and reshoring that's been happening across the country. VDE still managed to hold second place, though, which tells you how strong that fund has been. Then there's VFH, Financials. In the 1-year table, it's sitting dead last at $10,120, which looks terrible. But if you look at its 5-year column right next to it, you'll see $17,350. That's a fund that performed really well for years and then just hit a wall in the last 12 months. Strong long-term, weak short-term. And that's exactly the kind of thing the heat map makes easy to spot. Okay, so we've gone through all 7 segments and ranked all 76 ETFs. Now let's put them all side by side and see who actually won this thing. VDE takes the number 1 spot with $28,325. That's $10,000 turning into over $28,000 in 5 years, nearly tripling your money. And if you look at the top 5, 3 of them are sector ETFs. Not VOO, not VTI, not any of the funds that everyone talks about. None of them even made the list. Now let's look at the other end. Every single fund in the bottom 5 is a bond fund, with BND sitting dead last at $10,207. Think about that for a second. VDE turned $10,000 into $28,325, while BND turned that same $10,000 into $10,207. That is an $18,000 difference over 5 years from the same platform with the same starting amount. The only thing that changed was which fund you picked. Now, here's where it gets really interesting. When you switch to the 1-year picture, everything flips. VPL takes the top spot with a 55.59% return. $10,000 turned into $15,559 in just 12 months. And 4 out of the top 5 performers are international funds. Not a single U.S. stock ETF made the cut. So over 5 years, the U.S. dominated. Over the last 12 months, the rest of the world took over. That right there is probably the most important thing I can tell you from this entire video. Whoever's winning right now is not necessarily who's going to be winning 5 years from now. Leadership rotates, and it rotates hard. At the bottom of the 1-year rankings, it's mostly bonds again, but the one that really stands out is VFH. The Financials ETF came in dead last with just 1.2% return, which is actually worse than every bond fund on the platform over the last 12 months. But here's the thing. Its 5-year return is $17,350. That's a fund that spent years performing really well, then had one rough stretch that completely changed how it looks on paper. Context matters a lot when you're reading these numbers. So after going through all 76 ETFs across 7 segments, we actually have 2 winners, and they tell completely different stories. If you're going purely by the numbers, the winner is VDE, the energy ETF. $10,000 turned into $28,325 over 5 years. Nothing else on this entire platform came close. It nearly tripled your money, while VOO and VTI, the funds everyone talks about, didn't even crack the top 5 overall. If raw performance is your only measure, VDE wins this competition, and it's not even a close call. But here's the thing about VDE. The return was driven almost entirely by a once-in-a-decade setup. COVID crushed energy stocks to historic lows. Demand exploded back. Oil hit $100, and ExxonMobil and Chevron printed record profits. That kind of setup doesn't just repeat itself on demand. So yes, VDE won on paper, but chasing that return going forward is a very different bet. Which brings us to the second winner, and honestly the more interesting one. VYMI, the International High Dividend Yield ETF. This fund didn't just win its own segment, it came out ahead of every single large-cap ETF on the platform over 5 years, including VOO and VTI. And here's what makes it really stand out. It's the only fund in this entire video that made the top 5 in both the 5-year rankings and the 1-year rankings. Not just one time frame, both. A 14.92% average annual return over 5 years that turned $10,000 into $20,044. And then a 45.59% return in the last 12 months alone that put it at number 2 on the 1-year leaderboard. And most people have never even heard of it. It holds over 1,500 stocks across 40-plus countries. It pays you dividends while you hold it. And it's sitting on a valuation gap versus U.S. stocks that still hasn't fully closed. That's not a fund riding a one-time event. That's a fund with a real structural case behind it. So if someone asked me to name one winner by pure returns, it's VDE. If someone asked me to name one winner by the most compelling story, a fund that proved itself across both time frames, beat the most popular ETFs on the platform, and still has room to run, it's VYMI. 76 ETFs, 7 segments, and a winner. But knowing which ETF won the last 5 years doesn't matter if you don't know how to actually start building a portfolio with them. If you're ready to put your first $5,000 to work, click the video on screen right now.